All right, welcome in everybody. Hope you guys have had a good October so far. As always, let YouTube catch up to us in the live streaming world. But thank you guys for joining. I was just talking with Kelly, and this is our last AI circle before the election. So next time we'll be meeting, we'll have some news. So I'm sure there'll be lots to talk about after. But like I said, this is the last one before the election. So as you guys probably know, we're going to do Q&A towards the end of the call today. If you have anything related to the markets or even the election, feel free to toss those in the chat and we will most likely cover it. So I'm gonna welcome in Kelly here. Kelly. Oh, he's got a black screen.
I'm here. Hold on.
Of course, it was working perfectly fine. We were just having a conversation, and then we go live, and then stuff hits the fan. There, I think you were. Cool. We got you now. Kelly, how are you besides that little minor blip?
I'm doing well other than that minor blip.
Good. Let's go through. I'm just going to jump right into the disclaimer. We're going to try to keep this around 45 minutes today. So if you guys have questions, as always, I always recommend getting them in early. Make sure that we get to you. I do have one question from last time that we'll cover, but before we get into anything of substance, we do have to read the disclaimer. So iFlip Investor Inc. and iFlip Financial Services are not financial advisors and do not make, buy, sell, or hold recommendations on any financial instrument. This presentation is for educational purposes only. Unique experiences and past performances do not guarantee future results. All financial investments involve risk, and you should speak with your CPA or financial representative to ensure the iFlip smart folios you select are suitable for your investment profile before trading in a live brokerage account. Perfect. Here's the agenda as always. Not really any announcements per se to go over. No one should be seeing this identity verification pop up anymore, but if you are, just let us know if you need any help. We're going to dive right into the market update with Kelly. After that, as always, any trades the AI has made. And we've kind of been teasing this one for a while, but we're going to spend some time on the SPY today. Not to steal Kelly's thunder, but we finally got out of it. So it was a great trade. And sometimes you got to pat yourself on the back, excuse me. So Kelly, I don't know if you want to get your screen going and we can jump right into it, or if you have anything to say before you start sharing screen.
I think my screen's already shared, but hello everyone. And yeah, let's get into it. All right. Are we there, Lee?
Yep, you're all good. All right. I will get out of everyone's way so they can see the tickers.
Let's take a look, everyone. In front of you, of course, is the typical thing we've been watching for years. This is a chart of the Dow Jones Industrial Average. As you all know, I really don't take too much away from this particular average. It's only 30 stocks, and I'm not even sure they really represent the employment picture of America anymore. So that being the case, this average is really kind of living on its own legacy. As you can see, we recently placed a new high in the market approximately a week ago, Tuesday. And since then, we've come down just a little bit, about 2% here. We don't trade the Dow Jones Industrial Average through a symbol called the diamond, which is an ETF. However, we take a very deep view of the S&P 500 itself in terms of the spider. As you know, most of you who have one of our portfolios, if you look at it, you'll find that you have a large allocation of spider. That was up until last Tuesday. So here, I'm going to make this picture big so we can really kind of zoom in and see it. The S&P, I'll make it small real quick. As you can tell, since COVID, if we go all the way back to that, which is here, the market has doubled since 2020 COVID. So we can all understand that. That's the S&P. Straight up after that quick 33% down move, the market just rallied intensely with this one 2022 pullback. Now, however, as you know from our last AI circle, 2 weeks ago, we were mentioning that if we get some kind of a rally in the S&P, to a certain level that we had a likelihood of a profit take, and we did get it. We got it last Tuesday. I will highlight it here. The signal came right here on Monday, and on Tuesday morning we got out. The approximate exit area was around 584 on the spider, which is the SPY symbol. The market, as you can tell last week, is just sputtering along, really not doing much of anything. The market feels heavy to, I think, most of us. And today we had a marginal sell-off of just about 1%, a little less than that on the S&P. It was down a little more. Who knows? There's Tesla came in with a good number right after the close. Who knows what's going on with this? However, the market does have a tendency to feel heavy here. We are finally out of the S&P. For reference, we bought that S&P 500 literally here on the open of this day here, which was August 5th. And we pulled this from this here area here. We pulled it all the way out to this area here. We took out all of this move. That works out to be about 14.5%, just over 14%, inside of 2 months and a week. So actually, it's been exactly 2 months. It was almost the 5th to the 5th. So we consider that one of the good things about our system. If we do our jobs right, the markets do have behavior that we can find and how it repeats. So there's no accolade here. It was just the math of it. This was done literally on risk management. There was no AI in this particular movement. However, there is AI that is, of course, monitoring it. But in here, it was a risk-reward variant, which is the reason that we exited the trade literally a week ago, Tuesday. So good for us, good for you. Let's move on from there. Why is the market kind of languishing up here when all the news is good? Or is it? Let's look at the problem. Here's the problem right here. This is the 10-year note. These are called 10-year note futures. If you look at them, we had the rally and the rate cut. This was the rate cut area. The market moved up. The 10-year yield went down to 3.77. However, since that time, the market has all the way moved back to 4.20. Matter of fact, we are closer to the lows in price and the highs in interest rates than we are the highs. So what's happened is Jerome Powell had a 50 basis point cut, and he probably overstepped the boundary. It should have been a 25. Most people thought it would be a 25, except, of course, for the super doves. They got their 50. But now Fed fund futures are now pointing to a less probability of future rate cuts already. And by the way, 2 cuts out, we're now showing probabilities of 50%, 50 basis point cuts. They're not even 25 basis cuts anymore. So we are in a different environment. What's happened, of course, is because the long end of the curve went up in yield, the overall curve has more of a positive shape, but it is still inverted. And what that move, when you see it like this, you know what that is? That signals inflation. Now, we already know we've had inflation. Inflation has come down. The trend of inflation is lower. But we're in a really stubborn place right now where the prices that we've got that have been occurred and adjusted higher as a result of inflation will remain sticky as they did in the 80s. It takes many years to unwind higher prices. And here's the reason why it'll even take longer this time. Unions. So making no comment on the unions, what's happened is now we're in a new world where workers, and rightfully so in many cases, because the prices have gone up, a lot of their wages have not adjusted with them. So the contracts that they might have wrote 10 years ago are no longer relevant with the level of inflation we had. So that's why we're seeing so much more unrest there. They call this wage price inflation. In other words, the wages are going up because the prices are, and that's the inflation. It's the inflation in the wages. That's what happened in the 80s. And that was what was so hard to unwind. And that is why Chairman Powell very likely made a mistake with an aggressive 50-point basis cut a few months back. Now there's no way to unwind that. They were anticipating more cuts. I think that is over. If we get another one, it won't be this year. And if it is, I think that's extremely dangerous to the market. I think they need to put on pause everything, but we will see. Obviously, the Fed is not listening to me or you or any of the pundits. It is on its own course. But here's the reason why. Lower prices in bonds mean higher interest rates. That's what's going on. The dollar, of course, as you can imagine, got very strong as a result of that. The dollar has increased vastly as a result of the higher interest rates. Higher interest rates here attract more investments in bonds. And also, if they want bonds, you got to buy US dollars to buy those bonds if you're a foreigner. That's why the dollar has also rallied. This is, again, these are all things that go against a rising stock market in the short run. So that's what's happening. That's probably why we're kind of leveling off up here, and maybe why we took a little dip today. We'll see what comes with this. Let's look at the NASDAQ real quick. A very similar dip. However, the NASDAQ never made a new high. In other words, here was the highs, but the old highs were actually higher. Generally, if we have a little more sell-off here, that's called a divergence. That's another negative thing to look at. Don't get me wrong. There are more positives than negatives, but nonetheless, these are the little things that you keep an eye on when you're trying to navigate your portfolio and manage your risk. So here's another interesting thing, the VIX. So at all-time highs that we've seen over the last several months, look at the VIX is actually starting to increase. The VIX is overall going higher. It seems to not want to go below this 15 area. And now it's stubbornly, even though the market's just off its highs, it's stubbornly higher, literally about 25% higher than it was at previous lower prices. Normally, higher stock market prices mean lower VIX prices. However, I think we've hit a wall. And this is what this chart tends to point out too, is the price of the VIX. No matter how much more the stock market rallies, people are stubborn. They still think there's more volatility to come, and that's why this price is higher. If we look at the individual tech stocks, they're all close to their highs. Here's Apple, close to its highs, no downside. Here's Google struggling at its 200-day moving average. This particular stock actually looks weak to me, and it needs a really solid rally. I don't see where it comes from, though. Meta, same thing, just off its highs. Let's look at Amazon, kind of, a little closer to its highs, but again, it seems to be languishing. We're not making higher highs. Matter of fact, we're making lower highs. Microsoft, very similar situation. It's having trouble at its 200-day moving average. If we can cut through that, we can have lower prices, but right now it's hanging on. Netflix, obviously, we had the great number the other day, up 10% or 11% in a day this last, I think it was Thursday. But now here we are today, almost giving up the at least the range of that day, but still markedly higher and at new highs for Netflix. NVIDIA, solid rally, made an ultimate little baby new high here. Again, don't like it with the market where it is now, but it's still a very good stock, but I think we can buy it cheaper later. Oil, obviously, tensions in the Middle East. Sinwar is now dead. Israel has accomplished most of its goals. We all know that. Whoop-de-doo. I'm happy maybe there's a safer Middle East in the future. Oil prices have retreated from their highs, and that's just the price of oil. But if we look at the individual stocks, Exxon has just made a recent high, new high, and it's fallen off not nearly as much as oil. Why is that? Because they expect more unrest. The pipelines right on their highs, right area, at least with Energy Transfer. All Plains, a little not quite as good, right at its 200-day moving average. Again, these things pay hefty dividends, and we're coming into a dividend day very soon. It looks like that day is the end of the month, Halloween. And it will pay us 31 cents to own this $17 stock for maybe 1 week. So that's not so bad. I'll take that. Let's look a little further and kind of cut through them all. Let's look at the banking stocks. I mean, the banking stocks definitely are the last things to rally. What else is there to buy when everything else seems so rich in price? They bought the banks. Here's JP Morgan. Here's Bank of America. Here's Charles Schwab, a brokerage firm. It even rallied too. And this is the weakest link of them all. Charles Schwab is a brokerage firm, but it's also a bank. Keep that in mind. I keep an eye on Sally Mae because this is just something I keep an eye on. Why? Because I kind of suspect there's a chance one day that we do work with first-time home buyers to be able to help purchase a mortgage in the future for people when housing prices have gotten so out of reach. We'll see if anything ever happens there. But I think these are kind of solid bets in the short run. But we'll see with a new administration or even an existing one carry over from the Biden administration if these things will hold themselves up and actually move higher, if there's any kind of legislation that might help first-time home buyers. The Carnival, the cruise lines obviously made a huge run recently, and keeping an eye on those. They moved from the lower end of a range and they actually broke out above a range. I don't know where these things go, but if we look historically, in an economy that existed literally, right after COVID, the old highs, in this case, we're in the high 20s or 30s. We're now at 21, which means basically there's a chance for another 30% move in these if they were even to recover to their old highs. That's not bad, but we're already up approximately 40% from some of these prices. I don't know. So here I hold pat if you own them and do nothing if you don't. Norwegian Cruise Lines, just another example of the same. I'm going to switch over here real quick and take a look at the telecommunications. AT&T is just making incredible moves higher. This is such a boring stock, everybody. We know it. We bought it because of dividends. AT&T is paying 27 cents when it was a $21 stock, which basically means, call it 28 cents. We multiply that by 4. We're at about $1.08. $1.08 on $21. We're looking at literally 5.5%. And why we were buying it way before that, the yields were 6.7%. So if we are in these stocks, and some of you are in our portfolios, you're getting a hefty dividend and a price appreciation to boot. Prices have literally gone up 40% here as well. We own AT&T, and we also own Verizon. Verizon had some struggle the other day, but I think this is still a good stock, and I still think it has more room to go. Also paying a hefty dividend. So we like those positions. Let's get over to Bitcoin real quick, and then I think we can put a compendium on it. I look at the Bitcoin through the eyes of IBIT. IBIT is the proxy that we can buy inside of a regular portfolio that literally trades just like Bitcoin. We are actually long this in the BitFlip portfolio. We got long in this area here. We're holding on to a profit. Hopefully, any kind of a small move lower, we might get out of half of our position. But again, as you know, these are long-term plays to own. And if you don't want the volatility, what we do is we have the BitFlip AI portfolio where we own half of it as a core position always, but the other half is trading. So sometimes it's in the market and sometimes it's not. Right now it is. So you're 100% in. And we got a small profit in it. Let's hope we can get another future pop up and find a better place to get out and then wait for the next trade. This is a momentum model in almost every aspect. And this is a very a market that is really prone to the momentum of the buyers. When people are enthusiastic about it, they go buy it like it was like 1848 gold rush. Everybody was going to California to mine it. Well, same thing here. It looks very much the same. I do think there's higher prices in the future, but who knows what's to say come fall, the end of the fall. So there we go, Lee. I will make a mention to some stocks I think will split. I've kind of kept an eye on this one. It's called Texas Pacific Land. It's not in any of our portfolios, but I think this is a stock to keep an eye on. It looks extremely interesting to me. Basically, they deal with water and natural resources in Texas. They're one of the single biggest landowners also of the state in the state of Texas. And this is a stock that's over 1,000 a share. Generally, stocks like this split, and we'll hopefully you get a split. Generally, stocks move up 20% after a split occurs in the ensuing 12 months subsequent. So this is something I'm watching. If I can find a reason to get it into a portfolio, I will. Again, everything has become so rich in price over the last 4 months. It's very difficult to find bargains out there. Lee, I think that wraps it. We can go to Q&A.
I won't hold you to it, but I think when you were bringing up TPL last time, I want to say you were thinking it was maybe a 10 or a 20 for one split was what you're maybe expecting. Am I remembering that right, or am I off?
You are. Generally when the stocks get over 1,000, they do 20 for ones. We saw it recently in Nvidia.
Yep.
And the reason they do it is you want to kind of price your stocks where it's easier for institutions to buy round lots. They don't buy fractions. So when things are $50 a share, it's open to almost everyone. So that's
I remember pre-fractions in our portfolios when Amazon was over 3,000 there, and that sure drove up some minimum investments.
Well, that's the whole reason there, because you lose continuity with returns when you have these kind of investments where you have fractions. So technically, $1 should behave the same as $1,000 or $1 million. However, when you get into fractions, things do get strange. So if you own 1 1/4 shares, sometimes if we sell something, you still might have 1/4 of a share, but it's really kind of a meaningless thing. It doesn't 30% of 1/4 of a share of almost anything. Perfect. We're still talking dollar movements.
Awesome. I haven't. I'll double check. I haven't seen anything in the chat quite yet. I was going to. There was a question from last time, and honestly, this is one we get a lot. But people are a lot of times when they hear about us or when they first understand what we do, one common question we get is, hey, if I move, say I ACAT my shares over from Schwab, Fidelity, etc., can the AI just automatically manage them? I think it's a short answer, but go ahead.
The short answer is no. We don't. We only can manage the machine language component, and even the risk management component is designed around these specific symbols that we look at and apply mathematics to. So when we get a portfolio from somewhere else, 95% of the time, 95% of those stocks are what is in our portfolio. Right. Yes, there will be some that the AI can manage, but the AI will not manage your stocks when it first comes over. The only way they get managed is if we raise enough cash by selling some of those stocks and then buy one of our smart folios, then they are managed.
Yep. Not to create a CPA type conversation, but if it's an IRA, it's obviously a lot easier to just liquidate things at the delivering firm, move the cash over, then it's ready to get into whichever smart folios you want. It can get a little trickier if it's a brokerage account and you have to worry about capital gains and tax and all that sort of stuff. But just as a rule of thumb, I guess it is always easier to move cash over, and then it's investable into those smart folios Kelly talked about. But sometimes, honestly, it doesn't make sense to. Sometimes you have to be a little bit smart about it. I did see something come in the chat. Kelly, I don't know if you know this off the top of your head. Doug was actually at the Money Show in Orlando last week. He's asking about if you know off the top of your head the year-to-date returns on aggressive.
The year-to-date returns on aggressive right now are standing at around 22, 23%, right in that neighborhood.
And you were actually saying balanced this year thus far has done a little bit better than aggressive, right?
Because it was, but they're about the same right now. I did see balanced above, like at 24% at one time, and aggressive was less. And the only reason, of course, that is because the aggressive has more technology in it, and some of the technology is actually kind of hasn't participated in the rally over the last few months that some of the, for example, healthcare providers did, and some of the other stocks that we have in the other portfolios. They just made some moonshots. Like an example would be Carnival Cruise Lines.
Yeah.
You have a sleeper that just put on a 40% move.
I was gonna say
So
a lot of these people won't know the portfolio SPY eye, but if you're still in it from years ago, I'm almost positive that one's having a great year this year. A couple of
yes,
those are up 50 and 60%, right?
they're up. Yeah, they're up large because they have larger holdings of things like Carnival Cruise Lines or Norwegian or even the SPY G, which we were ultimately deeply long. Long meaning we're in the market where we own them.
Sure.
So yeah, it's it's like always. If you keep trying to chase the market, you probably won't do well. You'll be investing in the things that have already moved, and you will take the money from the things that haven't moved yet. And so this is the most common mistake I've seen with investors is they always try to say every year we're going to pick the winner, and they think the winner of next year is going to be the winner of last year. Not generally a good bet. Not
Yeah.
generally a good bet for a whole year.
Sure. And not to take Doug's question out of context, but just some other folks might be on here. They might have started in April or something. They're like, man, my aggressive hasn't made 22%. Just remind everyone, that it's
Well,
when
I'll
we're
give you
go
an
ahead.
example. We made 18% in the first quarter. That's January through March. So the big out of all of that, if you think if 1 month, 1 quarter gave all the gain, and you came in after that, your portfolio might only be up 4%.
Right.
But that's kind of the way the market moves. All it takes is really one super spectacular quarter. And by the way, you can kind of see it if we can go back to a quick chart of the S&P. So take a look. Here is 2024, the beginning. Look at the first quarter. Boom. Right there. That's the first quarter. I mean, it was half of the move just on the S&P. So the S&P made most of its money in that quarter, or at least half of it. But some of the other stocks that are in like the balance or the aggressive, they were really making even more. Like Nvidia, for example, it just exploded in that quarter. So here's the 2024. So Nvidia went from 50 to 9, almost 100. So that doubled in a quarter. But it hasn't, and it's doubled again since then. But if it happens in 1 quarter, then the other 6 months that we've had for the first 3 quarters, well, it didn't quite do as good over the following 2 quarters, but it still did well.
Yep. Well, one thing you've told me, and it really resonates, is you have to write down, maybe not even write down, but just be mindful of what your start date is. We have a lot of people that they'll say, "Hey, I'm going to move half my account over to you guys and test it out." And really, to give a fair comparison, you need to know where the market was at when you started, whether it's us or anywhere else. Compare it to the market, see how it did. But it's usually unfair to compare a whole year's worth of returns to 6 months or
Yes.
even less than that. So.
And so the way we do it in a way that's obvious is for everybody, when you come over, the main thing to do it is to say, where is the S&P? Where is that? What's the price of that? And that's the benchmark we use. So if you know where the S&P is when you move to flip, then when you look at the performance, look at it vis-a-vis or against the S&P. So if the S&P is down, when you start with us and the S&P is at, say, 500, and then you look at it, it's at 550, then hey, the S&P's gone up 10%. How much has my portfolio at Flip gone up? Compare it. That's the way to compare it.
Perfect. I didn't mean to open up a can of worms of returns and all that, but Stephen, please clarify for me. You said if I have technical questions, who should I reach out to? Please clarify if it's something on the platform. Likely myself or our support team can help if you're asking about the ins and outs and things into the weeds about portfolios being constructed and all that. Then this could be the right spot to get that question answered. It also may not be as well. One that we just came in, Tom. Just asked basically, where can I find more details on the portfolios and smart folios? So anyone who has an iFlip account, you'll click on the invest button on the top right hand side of your screen. If you're on the web version, on the app, it is, I believe it's on the bottom. Don't quote me on that, but you'll see invest in orange. This will bring up all the different smart folios you have to choose from. There's an allocation section that basically tells you everything that's in the portfolio. We'll give you an about section as to, sometimes they're more lengthy than others, honestly. Sometimes it'll tell you, hey, we built this portfolio because it's an inflationary hedging portfolio, or this one's in tech, this one's in oil. There's plenty of info on those, but where you find it is under that invest button. I'm not seeing another one. I did mention, Kelly, that we were at the Money Show. As you know, you've been to those. Some of those folks are a little more savvy than I would say our average customer. This may be too much for some people, but I thought it was really thought-provoking, and you'd talked to me about this before. People were talking about, I said how we just sold the SPY. They're like, well, why not go invest into an inverse ETF while you're in cash in the SPY? Go ahead and just take it and run from there.
We can run in a lot of different directions. Just because you have an exit because risk and reward are not conducive to owning a symbol doesn't mean that you think the market's going to go down.
Yep.
It's about risk and reward. It's not about direction. So if we think the market's going to go down, yes, if you think that, then because we sold it, then someone, if they wanted to, they can initiate a short position. They could buy the SH, which is a 1-to-1 inverse ETF of the S&P 500. However, the reason when we get out of a portfolio like this trade we had last Tuesday for the spider to get out was because risk no longer was relevant to the reward. So for example, when we put a trade on, we'd like to know that our risk is at least better than 1-to-1. However, if the trade is already on and we find out that the risk is 2 and the reward is 1, why should I own it?
Right.
In other words, do I need that last dollar? Because the last dollar I'm going to try to make might cost me $2. That doesn't mean I should be short the market. That just means that right now it's not a good area to own the stock, and the risk is too great for the reward is too little. That's why we would sell. By the way, as you would know, as you can further guess, if the market comes down, then all of a sudden risk reward will improve, right? Because now I know where a price I can defend. I'm taking a look again. Let's go to the chart that's up, which is, I'll go back to this S&P. Up here, I see my risk is almost literally, the way we do it is not these lines. These are just standard deviation lines, but we do something called an average true range, which is a volatility measurement in the form of price itself. So if the average true range on the S&P is say 16 points or 25 points, which is what it is, then I got to know that if the spider can lose 25 points, we got to be able to make at least 25. So up here, we felt that the math suggests, the math meaning the probability and the math itself suggests that, guess what? The next 12 points of gain would carry 25 points of risk. That was the exit signal. That's why. It is not a sell signal. It's just an exit signal as a result of risk reward being malaligned.
Perfect. Looking through a couple, and I'll just do right now, last call for questions. We'll probably wrap up in the next 5 or 10 minutes, depending on how many more flood through here, which you never know. Sometimes it's none, sometimes we get a bunch. Stephen clarified, I can take this one. So yeah, probably during the migration, what I'm suspecting is that the cash that was on the sidelines in the smart folios, and sorry, you can barely see my face. Not that you need to, but the cash that was on the sidelines is likely in your settled cash or buying power now. So you can add it to, I don't know if you have multiple portfolios, but you can always reinvest that or reallocate it towards the portfolio that you want it into. Kelly, since you weren't there, we're going to give you another money show question. Doug, again, can you talk about the AI software? Did you write the code, or are you using an industry platform with your proprietary code?
We wrote the code.
Very
Oh,
short.
going to keep going?
No, go ahead. I know it can be, some of it is over people's head. Other people will understand it. So give a little bit.
So just so you know, there are platforms that you can apply and be able to develop certain things with AI. There are many of them actually, but we are working with time series. So time series, of course, is data with a date and some data point next to it. And there's obviously we're dealing with the markets. When you're dealing with the markets, the first data points we have or time series is the price data. But we have all kinds of other data just like that. And so in order for us to use AI in our case, we actually have to write our own software to take the data we want and be able to bring it in and get the results that we are looking for. So all that's more on the naive side. To be more specific, we wrote the code with time series software you might be familiar with. A lot of the very good one. We particularly use a coding language called R. Why? Because R is developed around time series. There are many other languages that can do it, but R is actually very good for this. Also, when we use a large data model, which means for the AI itself, we not only are able to put in the predictors that we're looking for, which in our case are variance of probability and of price movement. In other words, the volatility itself and the price movement itself is a direct function of price, nominally, and of course relatively, which is the volatility. So when we do that, we feed the AI through our R program because it works with the time series. We feed it in. Then the AI itself, which is also, again, a large model, we feed it. And we feed it the predictors and we feed it the data and we pull it back. And then we take a look at that data in our own proprietary formats to be able to what we call map it. And the mapping process is something that says, okay, these predictors had, if we use these predictors in this kind of level of sensitivity, we're going to have 84%, for example, accuracy on a signal. And by the way, that's only on one symbol. So depending on how sensitive we put we create the predictors, do we want them to be wider or longer? Do we want more signals or less? We're going to get back different data. But to be clear, it is software that we wrote ourselves to be able to feed a large AI model. And so part of it is us and how we put the data in. Then it goes into an AI module, a large one, what they call a large AI model, and it comes back with a bunch of data, statistical data, that we pull back into the program and then map out. So I guess the direct answer is we wrote it. However, some of the models behind it, remember, large models can consist of several different kinds of AI models, are either part of the public domain, which you can go get yourself if you wish, from like on Python, or you can purchase them, or you could rent them that have more specific use cases. But in our case, we had to write almost all of our own software because our use case is just not available to our knowledge from third parties.
Perfect. I'm surprised we haven't gotten any questions surrounding the election. So we have, if you want to share anything, you're welcome to. We're just under a day away from being 2 weeks out, 2 weeks minus a day from the election. I'll just tell everyone now, our next AI Circle is going to be on the 13th, which will be a week and a day after the election. So who knows what's to come after that. But I know elections are big talking points in the markets. People always say the market's going to have a better than normal year and blah, 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 blah. But if there's anything worth chatting about here, feel free. If not, we're going to pick our Amazon gift card winner.
Okay. Well, the only thing I can speak to in terms of the election is I think most people in the country recognize now that the momentum is probably shifting on the margin to Donald Trump. And I wouldn't really, when I look at the markets, and then you look at, the pundits talking about the polls, I think they're kind of in lockstep. I kind of feel the markets kind of is on its highs. This is, again, me opining. The markets are on their highs because they're expecting a Trump victory. And if there is a Trump victory, the markets probably are going to behave a lot better, especially knowing that the Senate is likely to be Republican, but the House, on the other hand, could very likely also be back up in the air and move to the Democratic side, which would create that kind of that divisive checks and balances for not getting too many policies across. So my instinct is the market is actually on its highs over the last 2 weeks, 2.5 weeks. As you can see, this little movement here where my mouse is a result of the tide shifting Republican in this case, which tells me that generally the best case for the markets and the economy is probably Donald Trump, whether you like him or not. And there's a lot of people that don't, but there's a lot of people that do. If you like him or not, the market seems to prefer him, and that's the behavior. The other thing is it jives with the betting odds in Las Vegas. There's bets on who's the most likely candidate, the winner, and of course that's more decidedly for Trump. But who knows what that means? So I think the markets are anticipating right now a Trump victory.
Sounds good. I don't see any other questions. So there was kind of a lot. I don't know if you remember one that you really liked that you want to pick as the winner.
Well, I mean, to talk about the AI software, did I write it and all that? I guess we should probably, that's a fundamental question about what we do. I guess I have to, given the the short number of questions this time, let's go that direction. Let's give it to Doug Wood.
Perfect. Well, congratulations, Doug. I think you were 1 for 1. We might have had someone last time who was their first time joining us, and they might have won as well. So be sure to tell your friends because they could be our next winner as well. I don't have the screen up, and I'm sorry, but Doug, all you need to do is I will put it under, give me a second. So just email mailbag at iFlipinvest.com. I believe you already have an account set up or it's in the works, but just give us your account number and our team was going to reach out to you to basically show you how you redeem your Amazon gift card for being our winner tonight. So, Kelly, if you have any final remarks, feel free. If not, we will let everyone get on with the rest of their night, and we'll see them in a couple weeks.
Only final thoughts I have is I basically think the markets are going to kind of hang steady in here, maybe drift a little bit lower, waiting for the November 5th and 6th. And remember, we may not know the answer to who's the president on the evening of November 5th. So I think it could go a few days longer if it's close. If it's not, hopefully we know. But there's no reason for the market to make a new high or go down very much either, going into an election that seems to be so tight. So it's going to be a very interesting next AI circle because there should be, frankly, a lot of movement.
Plenty of talking points.
Oh, yeah.
Awesome. Well, thank you guys for joining tonight. There's a lot of you on here for a while, so thank you for being here. Like I've already said, the next one is going to be the 13th. I'll put that on the screen again. Same time as always. In the meantime, have a great rest of your October. Have a great Halloween. Almost forgot that that's coming up. And we'll see you at the start of November. So take care, everyone, and have a great rest of your night.